Imagine an island. Small, tropical, barely a speck on the map. Palm trees, turquoise waters, paradise. But behind the postcard beauty, this island hides a secret. It doesn't run on coconuts or tourists. It runs on money. Specifically, money that doesn't want to be found. This is the story of how a sleepy island transformed itself into a tax haven paradise, one of the biggest loopholes in the global financial system. This is the Cayman Islands, a cluster of small Caribbean islands with fewer people than a mid-sized city. The Cayman Islands are home to about 76,000 people as of mid-2025. Yet, it's home to over 100,000 registered companies. That's more companies than people. And the reason? Taxes. Or, rather, the lack of them. To understand that, we have to go into the past. In the mid-20th century, Cayman was quiet. Fishing, seafaring, and a trickle of visitors. A catalytic moment came when Barclays opened a bank in 1953. And then Cayman rewired its legal infrastructure through the company's law, a modern corporate statute built on English law that made it easy for foreign investors to incorporate locally. Over the next decade, the territory wrote rules to compete with the Bahamas and others, culminating in the Confidential Relationships Preservation Law of 1976, which criminalized unauthorized disclosure of client information. That law, now updated, became famous worldwide, and this led to the country became what we call a tax haven. A tax haven is a place with little or no direct taxes and strong financial privacy. In Cayman, there's no corporate income tax, no personal income tax, no capital gains, no inheritance, no payroll, and no property tax. The government funds itself instead with import duties, work permit fees, and registration renewal fees on all those offshore entities. Locally, officials prefer the term tax neutral, but the effect for many investors is the same. Near zero direct taxation on profits booked there. Imagine a company called Megaphone that sells phones in the US, Europe, and Asia. It makes a lot of money where its customers are, but it also wants to legally lower the taxes it pays overall. So Megaphone sets up a company in the Cayman Islands. This is often an exempted company, which just means it's registered in Cayman, but does mailbox with a new. Our Cayman company owns the brand and software for our phones. So every time Megaphone sells a phone in the US or Europe, the local branch has to pay a fee to the Cayman company to use that brand and software. That fee is called a royalty or license fee.
Mathematically, it would look like this. The US branch sells a phone for $1,000. It spends $800 making and marketing it. Normally, the profit would be $200. But now, the US branch also pays a $150 license fee to the Cayman company for using the brand/software. So the US profit shrinks to $50, and the $150 moves to Cayman on paper. But the question is, why Cayman? The answer is simple. Cayman doesn't charge corporate income tax. So that $150 sitting in the Cayman company is taxed at 0% there. Result? Megaphone's global tax bill is lower because more profit lives where taxes are near zero. We didn't ship phones to Cayman, we shipped profits to Cayman, using paperwork, royalties, licenses, intercompany loans. That's why people call the Cayman entity a shell company. It mostly exists on paper to hold rights and money flows. You might be thinking, is it legal? It can be legal if it follows the rules. Many big companies do versions of this. It becomes illegal if you lie, hide owners, use fake invoices, or wash criminal money. That's where regulators step in. Cayman's regulatory framework for mutual funds and private funds has turned it into the world's preferred home for hedge funds, with about 30,150 funds registered in 2024. But why the investors trust it? Firstly, stability. It's a British overseas territory using English common law, which global investors trust. Secondly, specialized laws. Cayman iterated corporate and fund statutes for decades, the Companies Law and Mutual Funds Act among others, creating a tight, investor-friendly framework. Thirdly, ecosystem. Once critical mass arrived, banks, law firms, administrators, Cayman became a one-stop shop for complex finance. In 2016, the Panama Papers, a leak of 11.5 million documents from the law firm Mossack Fonseca, exposed how elites worldwide used offshore structures to hide money, dodge taxes, or skirt sanctions. It wasn't about Cayman alone, but it yanked the entire offshore industry into public view, Cayman included. There were political resignations, investigations, and a global push for transparency. Eventually, Cayman had to make some changes. In 2017, it introduced a beneficial ownership register system so authorities can see who ultimately owns local entities, not public but accessible to competent authorities. And in October 2023, FATF removed Cayman from its gray list, acknowledging improvements in anti-money laundering enforcement. Europe followed by delisting Cayman from its anti-money laundering list in 2024.
Supporters say Cayman is now one of the most regulated offshore centers. Critics say beneficial ownership should be public to be meaningful. For locals, the economic impact is mixed. On one hand, Cayman now boasts one of the highest GDPs per capita in the region, and finance is the largest contributor to GDP, not tourism. On the other hand, growth hasn't felt even. Inflation and high living costs hit residents, and critics say many offshore profits never land in the local economy. The government's own reports show finance remains the biggest sector, while tourism is cyclical, booming post-pandemic, but still secondary in output. But why doesn't the government push tourism? That's a tricky situation for Cayman. Tourism brings jobs, but it's volatile, vulnerable to hurricanes, recessions, pandemics, and airline capacity. Finance produces steady fee income and high-wage jobs for lawyers, accountants, compliance officers, and fund administrators. Government revenue is more predictable when it comes from duties and corporate registrations than from seasonal hotel occupancy. That's the economic calculus that shaped modern Cayman. It's not just Cayman. There's a network. Bermuda, Luxembourg, Singapore, the British Virgin Islands all serve similar roles. Together, offshore havens cost governments hundreds of billions in lost tax revenue every year. That's money that could improve healthcare, education, or infrastructure, but instead stays hidden. Meanwhile, everyday folks pay taxes at home. The ultra-wealthy and multinational corporations use these loopholes to pay far less or nothing at all. It creates a two-tier system, one for ordinary citizens, another for the super rich. So next time you think of the Cayman Islands, know that behind the tropical beauty lies a financial engine crafted for global secrecy. A paradise, but not for everyone.
Thanks for watching.